Hello, everyone. This is Harley Lank, Portfolio Manager of the Fidelity Fund's U.S. High Yield Fund. The markets have rallied over the last week of March and the first 3 weeks or so going into April, really driven by a couple of important factors. The acceleration of the spread of the virus is largely behind us or close to being behind us here in the United States. But really more importantly, we have seen an unprecedented response from the Federal Reserve and the Treasury Department within the government. So we have seen over a $2 trillion stimulus package that has been announced and enacted here in the United States. And we've seen some unprecedented moves by the government, including the announcement that the U.S. Treasury and the Federal Reserve will be investing in non-investment grade bonds, fallen angel bonds, former investment grade bonds that are now trading at non-investment grade ratings levels, and also investing in the high yield ETFs. So this has really stabilized the marketplaces, most risk asset classes, the combination of those two factors. So while the markets have recovered, the U.S. high yield marketplace is still yielding over 8%, has a spread of over 750 basis points, and is trading at roughly 90 cents on the dollar. And so on a historical perspective, U.S. high yield is still inexpensive. Spreads are 200 basis points over the long-term average. Now, of course, that's justified based upon the fundamental concerns and the fundamental challenges that the U.S. economy is going to be facing for at least the next couple of quarters. So the important question is this fair compensation? How do I think this will play out, and what does this mean for investing in high yield? So let me start by saying I strongly believe there's not going to be a V-shaped recovery. It's going to be a very, very slow, very gradual recovery. But based upon all of the access to information and research that we're doing across the Fidelity platform, I strongly believe that there is a very high probability that, number one, we're going to see some sort of a cure for the virus within the next 6 to 12 months. And more importantly, we're going to see, with a high degree of probability, some sort of a vaccine that will be produced on a mass basis for the globe within the next 18 months or so. So at that point in time, over the next 1.5 to 2 years, the world will be moving much closer to normal. And when that occurs, spreads in U.S. high yield will be tighter than where they are today. So if you're a buy and hold investor with a view of the next 18 to 24 months, I think you will make good money investing in U.S. high yield. And of course, that's largely how we invest. We take a long-term fundamental view of the companies that we're investing in. However, over the next 18 months or so, we are going to be living in a period of volatility. So we're going to be faced with weakening fundamentals. And so that's going to be the headwind or the challenge that investors are going to have to grapple with. And the government has made it very clear that it will do whatever it takes to support the economy. And so for the next couple of quarters, with the positive view of the government stepping in to do, quote, whatever it takes to support the economy, that should keep risk asset classes and the high yield asset class, within a reasonable trading range with some volatility. So our job as long-term investors is really to look for the mispriced securities, taking a 1 to 2 year view, and taking advantage of short-term dislocations in the marketplace. And the core and foundation of all that we do is looking for the long-term winners. And again, with a long-term view, I think this is a good entry point for investors to invest in the U.S. high yield asset class.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书或投资人须知。